Everyone loves a comeback story. Sports has had its share, including Muhammad Ali, Mario Lemieux, Michael Jordan, Peyton Manning, Andre Agassi, and the list goes on. So is Hollywood. After 20 years of relative obscurity, famed 80s brat packer Robert Downey Jr. reemerged as Iron Man and has reportedly earned $435 million in that role. I don't follow sports closely, nor do I get out to the movies often, but for a financial nerd like me, there is a 2022 comeback story that I am very excited about: the comeback of value stocks. So what is a value stock? A value stock is a stock trading at a low price relative to a measure of its fundamental value. In other words, it's cheap. Basically, these are stocks that provide the opportunity to pay less for a set of future cash flows. This results in a higher expected return. These stocks can offer investors a value premium, which is the return differential between stocks with low relative prices, the value stocks as we have just identified, and high relative prices, which we call growth stocks. For the past few years, value stocks have underperformed their flashier counterpart, growth stocks. The FANG stocks and other growth stocks hogged the limelight as investors rushed to participate in these popular investments, grabbing the headlines. Growth investors might have pointed to the 3-year period ending June 2020 as one of the worst periods for value, and they would have been correct. Value stocks were out of favor for many investors who declared we may be in a new normal. Investors who used data as a guide and adhered to the belief in the value premium knew that the premium could show up quickly and forcefully. That is what we have seen in 2022 with the Russell Growth Index down 27% this year, and the Russell Value Index, while also down only 8%. Negative returns are nothing to cheer about, but the reemergence of the value premium is. The rub is that we don't have evidence that informs us of when this premium will show up. So we know what a value stock is, what a growth stock is, what the value premium is, and that the value premium was not there for several years. So why am I excited about the comeback of the value premium? Most importantly, I care because Greenspring equity portfolios, while investing in the entire market, has a tilt or higher weighting in value stocks than the index. This has paid off well for our clients. A second reason why I care is because this comeback validates Greenspring's data-driven approach. It is academic research, not investor whims, that drives how we structure portfolios. 100 years of data from the US market and 50 years of data, the furthest we can go back and have reliable data from markets outside the US, has shown that on average, value outperforms growth. Academic research still matters. If 2022 was such a great year for value, does that mean the comeback is over? No one knows what will happen in 2023, but we can look back at the data to see what has happened in the past. In years where value has had the strongest performance, top quartile years, the following year had an average annual value premium of 4.74%. In the weakest years for the value premium, the next year had an average annual premium of 4.35%. Again, we are not in the business of making predictions, but historical context is interesting. It has not been easy to be a value investor over the past few years. We live in a world where headlines create urgency that may lead investors to veer off course. Consistency and trusting the evidence become key. Patience for value investors has been rewarded with a sharp turnaround after a long slump. However, only investors who have been patient and have stayed invested during this slump, knowing a comeback was coming, have been rewarded.